You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Usually when we talk about a medical diagnosis, there's this expectation of clinical precision. You break your arm, the x-ray shows that jagged white line, and the doctor just points to the fracture.
Right, yeah.
It's visible, it's categorized, and the path to fixing it is entirely objective. You know exactly what to do.
It's a closed system, the variables are known, and the solution doesn't require you to, decipher competing philosophies or whatever.
Exactly. But step into the world of investing, and suddenly it feels like you've walked into a room where everyone is pointing at a million different blurry x-rays and screaming entirely different diagnoses at you.
Yeah.
The financial industry really thrives on projecting this aura of immense complexity.
Oh, absolutely.
They make it seem like if you don't possess a proprietary algorithm, or if you aren't constantly rotating your capital based on, the latest jobs report, you're basically going to lose everything.
Oh, the industry actively manufactures that complexity because, frankly, complexity is profitable to gatekeep.
Right.
When you have over 4,000 distinct exchange-traded funds on the market, not to mention individual equities, municipal bonds, alternative assets.
It's overwhelming.
It creates a paralyzing environment. That sheer volume of options breeds anxiety, and that anxiety drives investors right into the arms of high-fee active management.
Chaos to make the fear go away.
Exactly.
Well, welcome to this deep dive, because today we are dismantling that manufactured complexity. We are tearing down the idea that successful investing requires constant neurotic tinkering.
Yeah.
We're synthesizing a massive stack of data today. We've got historical performance metrics from ClaredX, strategic frameworks from The Motley Fool, a comprehensive blueprint from my ETF journey, and a step-by-step ATI investment transcript.
And it's amazing how much they align.
It really is. Looking across all these sources, they converge on a central mathematical reality that is going to fundamentally frustrate the active trading community.
It genuinely flips the script on how wealth is actually accumulated over a multi-decade timeline.
Because here's the surprise premise right off the bat. You don't need a portfolio of 40 individual stocks.
No.
You don't need to hedge with complex options strategies, and you certainly don't need an expensive financial advisor siphoning off your compounding interest.
You really don't.
The data we're looking at proves that you can capture the entire global investment universe and mathematically outpace the vast majority of active traders using exactly 3 funds.
The 3-fund portfolio.
Just 3.
It is the ultimate exercise in constraint. We're talking about engineering a lasting wealth generation engine with virtually zero maintenance.
Yeah.
It requires acknowledging that attempting to outsmart the aggregate intelligence of the global market is, well, it's a fool's errand for a retail investor.
So let's get right into the architecture of this thing. The bedrock of this strategy relies on 3 specific Vanguard ETFs.
Right.
One for the total U.S. stock market, one for the total international stock market, and one for the total U.S. bond market.
Right.
We are talking about VTI, VXUS, and BND.
Yeah, those are the tickers. And before we get too deep into the weeds on the tickers, we should probably just quickly define an ETF for anyone who might just need a refresher.
Yeah, good call. So an ETF, an exchange-traded fund in plain English. Instead of betting your entire grocery budget on just one brand of cornflakes, an ETF is like buying the entire cereal aisle at a fraction of the cost.
That's a great way to look at it. What's fascinating here is that by combining just those 3 specific Vanguard funds, you are literally buying the investable universe.
The whole thing.
The whole thing. The underlying mechanism here is the total elimination of uncompensated risks.
Okay, what does that mean exactly? Uncompensated risk.
So in finance, you are rewarded for taking on systemic market risks, the risk that the entire economy goes into a recession. That's why stocks pay a premium over cash.
Right, because things go up and down?
Exactly. But you are not inherently rewarded for taking on the isolated corporate risk of a single company going bankrupt. When you hold thousands of global equities simultaneously, the collapse of any single corporate entity becomes a microscopic, basically irrelevant blip on your radar.
You don't even feel it.
You don't. The portfolio naturally and dynamically shifts as the global economy evolves.
Wow, okay. But to really trust this architecture, I think we have to stress test the actual engines driving the growth. Like, what is inside these buckets?
We have to.
So let's look at the domestic side first.
Yeah.
The Vanguard Total Stock Market ETF, ticker VTI. When someone buys a share of VTI, they aren't just tracking the S&P 500, right?
No.
They're buying fractional ownership in over 3,600 U.S. equities.
And that distinction between the S&P 500 and a total market fund like VTI is absolutely crucial.
Everyone just talks about the S&P 500.
Exactly. A fund like VOO, which tracks the S&P, gives you the 500 massive mega-cap behemoths that dominate our daily lives, the Apples, the Microsofts.
Right.
But VTI goes deeper. It includes the mid-cap and small-cap regional businesses all across the American economy.
And the numbers backing that broader exposure are pretty striking. Looking at the ClaritX data from June 2026, VTI posted a trailing one-year return of roughly 21.03%.
Which is huge.
And the MyETF Journey source tracks a 5-year return of 15.20%. Now, the sources specifically attribute part of that performance to an inherent growth premium that comes from holding those smaller companies. I want to explore the mechanics of that premium. Why does going beyond the S&P 500 actually matter in a bull market?
Well, it comes down to structural torque. Think about the mathematical reality of corporate expansion.
Okay.
A company valued at $1 billion has a far more realistic path to doubling its market cap to $2 billion than a $3 trillion tech giant has of doubling to $6 trillion.
That makes so much sense. It's just easier to grow when you're smaller.
Exactly. Smaller companies have aggressive runway. So during an economic expansion, those small and mid-cap components add a vital layer of accelerated growth potential. They act as this hyper-efficient engine additive that you completely miss out on if your portfolio is exclusively constrained to the mega caps.
Right, so you're basically capturing the companies before they become the dominant players in the S&P 500.
Precisely. You own them on the way up. Now, for the absolute minimalists out there, my ETF journey does mention an alternative. The SPDR portfolio S&P 1500 composite.
Right, ticker FPPM.
Yeah. It's a slightly more concentrated approach, holding 1,500 stocks instead of 3,600, but the core philosophy remains the same: broad domestic exposure.
Gotcha. But here is where the consensus in our source material actually fractures, and I want to push on this a bit.
Good national allocation.
Exactly. So the second pillar of this strategy is the Vanguard Total International Stock ETF, VXUS. This fund holds over 8,000 international stocks.
It's massive.
Yeah, and the ClaritX data reports a huge 26.81% trailing one-year return as of June 2026, which is largely driven by the explosion of Asian tech and semiconductor markets. Okay, let's unpack this, because the Motley Fool source vehemently argues for a totally different approach here.
Oh, they do.
They suggest abandoning the international bucket entirely and replacing it with the Schwab U.S. Dividend Equity ETF, SCHD.
Yeah, that is a persistent, highly contested debate in modern portfolio theory right now.
And honestly, I can see the appeal of the Motley Fool's argument. SCHD screens for 100 high-quality, fundamentally sound U.S. companies with a long history of paying and growing their dividends.
Stable companies.
Yeah, and it's currently sitting on a yield of about 2.99%. We've just watched the U.S. market ruthlessly dominate global returns for over a decade. So why on earth should an investor dilute their portfolio with international equities when they could just stack high-quality, dividend-paying American powerhouses?
Well, their argument for SCHD is incredibly seductive, especially given the recency bias we all suffer from. Yeah. The U.S. market has indeed been on a historic tear,
right,
but relying exclusively on domestic outperformance requires you to believe that the cyclical nature of global economics has permanently broken.
Which it probably hasn't.
Right. The ClaritX research advocates for VXUS specifically because geographical diversification protects you against regime changes.
Regime changes meaning like a period where U.S. exceptionalism just stalls out.
Precisely. Global markets operate in massive multi-decade cycles. If we look back at the 1970s or the massive stretch from 2000 to 2009, the so-called lost decade for U.S. stocks, international equities drastically outperformed the S&P 500 during that time.
I totally forgot about that.
Most people do. So VXUS isn't just about capturing the current surge in Taiwanese semiconductors or South Korean tech. It's a structural counterbalance. If the U.S. faces a severe localized stagnation due to, say, domestic policy, inflation, or regulatory shifts, VXUS ensures your portfolio isn't utterly paralyzed.
Well, you're basically buying insurance against American economic hubris.
And you're participating in the industrialization and technological advancements of emerging markets at the same time. Yeah. The 2.99% yield of a domestic dividend fund like SCHD is fantastic for stability, But replacing your entire international exposure with it means you are making a massive, concentrated bet on a single country's ongoing supremacy.
And the three-fund philosophy rejects concentrated bets entirely.
Completely.
Okay, I see the structural logic there. We have our dual growth engines, VTI capturing the entirety of the U.S. economy, and VXUS capturing everything else on the planet.
Yeah.
But growth engines are fueled by equities, and equities guarantee extreme volatility. Which brings us to the third component, the shock absorber.
The bonds.
Right, the Vanguard Total Bond Market ETF, BND, which holds over 11,000 U.S. investment-grade bonds.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
Bonds serve as the indispensable ballast of this architecture. Equity markets are prone to manic emotional swings.
Up and down every time the wind blows.
Exactly. But bonds are generally uncorrelated to those swings. When equity valuations collapse and panic sets in, institutional money usually flees toward the perceived safety of fixed income assets.
Which pushes bond prices up.
Right, which often causes bond prices to stabilize or even rise. They mute the overall volatility of the portfolio so you don't panic.
But I'm looking at the My ETF journey data, and frankly, I need to play devil's advocate here for a second.
Sure.
Their historical data shows that over the last 5 years, BND had a negative 0.50% return.
Right.
For a younger investor, someone in their 20s or 30s with a massive time horizon, a negative return over half a decade is an incredibly tough sell. Aren't bonds just for retirees? Why would a 30-year-old voluntarily anchor their compounding growth with an asset that just bleeds value?
That critique is entirely valid if you only look at the macroeconomic environment of the previous decade.
Okay.
We spent years in a ZRE environment, zero interest rate policy.
Right, money was basically free.
When central banks hold rates near zero, bonds offer virtually no yield, yet they still carry duration risk if rates ever rise. And as rates did violently rise to combat inflation, existing bond values dropped, resulting in that negative 5-year return.
Makes sense.
But the macro environment has fundamentally, structurally shifted as of 2026.
The interest rate regime changed.
Radically. The most compelling data point from Vanguard in this entire deep dive is the current fixed income landscape. BND is currently offering a 4.50% 30-day SEC yield as of June 2026.
Wow. 4.50%. That is a massive paradigm shift from the, 1% yields we saw a few years ago?
It changes the entire mathematical calculation of portfolio construction. You are now generating highly meaningful passive cash flow simply for holding your volatility hedge.
So the anchor is now paying you handsomely to hold it.
Exactly. But beyond the yield itself, for a young, aggressive investor, holding even a modest 10% allocation in bonds serves a highly strategic purpose. It is your dry powder.
Okay, I want to explore that concept of dry powder because it speaks to the mechanics of capitalizing on a crash rather than just, surviving it.
Well, think about it. When a severe market correction inevitably occurs, when global equities drop 20 or 30%.
Which happens.
Right, it always happens. You do not want to be fully deployed in stocks with zero liquidity. If you are 100% in VTI and it drops 30%, you are just a passenger watching your net worth evaporate.
You can't do anything but watch.
But if you hold a 10% or 20% allocation in stable bonds paying 4.5%, you have ammunition. You can liquidate those bonds whose value has likely held steady or gone up and redeploy that capital to buy equities while they are heavily discounted.
Oh, I love that. You are structurally forcing yourself to act like an institutional buyer. You have the liquidity to go shopping while everyone else is panic selling.
Exactly. It removes the emotion and relies entirely on mathematical rebalancing.
So the architectural foundation is set. VTI for aggressive domestic torque, VXUS for cyclical geographic balance, and BND for stability, yield, and liquidity.
That's the trio.
But the brilliance of this methodology isn't fully apparent until we examine the underlying mathematics of cost.
Right, the fees.
We have to discuss expense ratios, because this is where the traditional financial advisory model really takes a beating in our source material.
The expense ratio is the silent aerodynamic drag on your compounding interest. It is arguably the single most controllable variable in investing, and yet it is the one most retail investors fundamentally ignore.
It's crazy. The comparison the sources draw between passive ETFs and active management is staggering. VTI and BND carry an expense ratio of 0.03%.
Basically nothing.
VXUS sits at 0.07%. We are talking about fractions of a basis point. Contrast that with traditional actively managed mutual funds, or wealth advisors, who routinely charge a 1% assets under management fee every single year.
The financial industry has done a brilliant psychological job of making 1% sound utterly benign.
They really have. A 1% fee sounds like a rounding error, like leaving a penny on the sidewalk.
Yeah.
But let's apply a better metaphor here to make it feel visceral. Think of an investment portfolio like a commercial aircraft flying a 30-year route. That 1% fee isn't a one-time toll at the gate. It is a permanent aerodynamic drag on the fuselage. Or, imagine you have a $100,000 portfolio. 1% might only be $1,000 in year one. But you aren't just losing that $1,000. You are permanently severing the compounding growth that $1,000 would have generated over the next 29 years. It's like having a hole in your bucket that drains tens of thousands of dollars over 30 years.
It creates an exponential divergence in your flight path. Over a multi-decade timeline, a 1% drag can easily consume hundreds of thousands of dollars of potential wealth.
Hundreds of thousands.
It alters the fundamental destination of your retirement.
And people willingly accept this drag because the active management industry sells them a highly compelling narrative. We are smarter than the market. You're paying us 1% to navigate the turbulence, pick the explosive winners, and avoid the catastrophic losers.
But the data completely obliterates that narrative.
Yeah.
The Claridex research cites longitudinal data from S&P Dow Jones indices, which tracks active manager performance against their benchmark indexes. The historical reality is that over a 15-year timeline, the overwhelming majority of highly educated, vastly resourced active fund managers completely fail to outperform a basic broad market index.
So investors are paying a premium 1% fee to ultimately underperform the market.
Yeah.
They're literally paying for the privilege of underachievement.
Precisely. The market is incredibly efficient. Trying to consistently find mispriced assets year after year, net of a 1% fee, is a statistical improbability.
Wow.
By utilizing these three ETFs with expense ratios near 0.03%, you guarantee that you capture the aggregate macro-level growth of global capitalism. Almost every single cent of your invested capital remains in the engine, compounding without friction.
It is the democratization of corporate profits. Okay, so the logic is bulletproof, the assets are selected, and the fees are virtually eliminated. But how does an investor actually execute this blueprint on payday?
Right, the logistics.
We need to talk about asset allocation, the specific percentages of how we divide this pie.
Allocation is where you customize this rigid framework to your personal risk tolerance and time horizon. The My ETF Journey FAQ and the ATI transcript align on a very standard, highly resilient starting point for beginners. A 6-20-20 split.
Meaning 60% of your capital deployed to the U.S. market in VTI, 20% to the international markets in VXUS, and 20% anchored in BND.
Yes. It provides substantial equity exposure for long-term growth while maintaining enough fixed income ballast to smooth out the ride. But, that ratio is fluid. If you are a 25-year-old with 40 years of accumulating ahead of you, your capacity to absorb volatility is massive. You don't need a 20% anchor.
Because a market crash in your 20s is actually a buying opportunity, not a retirement threat.
Exactly. So a younger investor might tilt much heavier into equities, utilizing a 60-30-10 split.
Okay.
60% domestic, 30% international, and just 10% in bonds for that dry powder we discussed. Conversely, as you approach retirement age, the math flips. You face what we call sequence of returns risk.
What's that?
It's the danger of a massive market crash occurring exactly when you need to start withdrawing funds to live on.
Right, because you don't have the time horizon to wait for the market to recover anymore.
Right. So a 60-year-old investor might defensively pivot to a 40-20-40 allocation, holding 40% in stable income-producing bonds to preserve their accumulated capital and generate yield.
Okay, the mechanics of the allocation make total sense, but here's where it gets really interesting. I have to bring up the ultimate psychological hurdle here.
The temptation.
The temptation to pick winners. Everyone has that one friend or colleague who bought NVIDIA before the AI boom, or caught Tesla at the exact right moment, and they won't stop talking about their explosive returns. When I see major tech companies dominating the news cycle with trillion-dollar valuations, why is it a bad idea to carve out 20% of my portfolio and just bet on the obvious, undeniable winners?
It's human nature to want to capture those astronomical lottery-like returns, but if we connect this to the bigger picture, we have to look closely at the asymmetric risk you are taking when you try to pick the next NVIDIA. The Claridex data is definitive on this. Automated dollar cost averaging, which just means investing a set amount regularly. into these three boring index funds historically crushes the returns of the average retail stock picker. And the reason comes back to isolated corporate risk.
The vulnerability of a single entity.
Exactly. A company can have a brilliant, world-changing product, but their stock price is tied to variables entirely outside of their technology. They could suffer an accounting scandal.
Right.
The CEO could make a catastrophic public misstep. A sudden, massive regulatory crackdown could instantly alter their business model. Or a disruptive new competitor could emerge from nowhere and decimate their market share in a matter of months.
We've seen it happen to seemingly invincible giants over and over again. Enron, Blockbuster.
Exactly. When you actively allocate capital to individual stocks, you are trading the mathematical probability of long-term wealth generation for the highly speculative fantasy of overnight riches. The downside risk is absolute. A single corporate failure can wipe out that entire segment of your life savings.
That's terrifying.
The three-fund approach fundamentally sacrifices the chance of doubling your money in a year in exchange for an extraordinarily high probability of building generation-altering wealth over decades. You are buying the entire haystack instead of frantically searching for the needle.
You give up the lottery ticket for a guaranteed seat on the wealth-building train.
Well said.
So, let's get into the operational logistics. The sources provide incredibly clear directives on how to physically build this machine. Step 1 is selecting a low-cost brokerage. The consensus points to Vanguard, Fidelity, and Charles Schwab.
And it is vital to note that this strategy is platform agnostic. If you prefer the user interface of Fidelity or Schwab, you can easily replicate this exact Vanguard portfolio using their native equivalents.
So you don't have to use Vanguard just to buy Vanguard ETFs.
No, not at all. Or you can use their own index funds. Fidelity offers FSKAX for the total U.S. market, and Schwab has SCHB. The underlying holdings and the near-zero expense ratios are mathematically identical. The platform is just a conduit. The strategy is what matters.
Got it. Okay, step 2 is the automation. You configure the brokerage so that the moment your paycheck clears your checking account, a predetermined sum is immediately drafted and allocated into your chosen 60310 split. You remove the decision-making process entirely.
You never even see the money.
Right. And step 3 is activating DRP, the dividend reinvestment plan.
DRIP is the silent engine of exponential compounding. When your ETFs pay out their quarterly dividends, like that 4.5% yield from the BND fund, you do not let that cash sit idle in a settlement account.
Because it's not doing anything there.
Right. The brokerage automatically uses those dividends to purchase fractional shares of the underlying ETF. Your money is automatically buying more money-generating assets, creating a recursive loop of wealth creation that runs entirely in the background.
Which leads to the final and arguably most difficult step in this entire process. You log out.
You log out.
You close the laptop, you delete the app from your home screen, and you walk away. Because if the architecture is automated, virtually free, and mathematically sound, the only variable left that can destroy this world-class portfolio is the human element. The behavioral traps.
The psychological friction of doing absolutely nothing is profound. The sources heavily emphasize that the most catastrophic error an investor can make with this strategy is a failure of emotional discipline during severe market volatility.
The instinct to panic sell.
Yeah. The entire premise of this lazy portfolio is that you become immune to the daily financial news cycle. But when a macroeconomic shock hits and you open your statement to see your net worth has plunged by 25% in a month,
it hurts.
The evolutionary psychological urge to liquidate your holdings and flee to the safety of cash is overwhelming.
It feels like you're stopping the bleeding.
It feels incredibly logical in the moment, but selling during a massive drawdown does only one thing. It permanently crystallizes temporary paper losses into permanent financial devastation.
You lock in the loss.
You lock yourself out of the inevitable market recovery, completely destroying the compounding trajectory of your portfolio.
And the Claridex source points out a second, more insidious behavioral trap.
Yeah.
It's not just panic selling. It's the temptation of unnecessary complexity. It is the lure of satellite ETFs.
Oh, this happens all the time.
Right. You read an article about the boom in artificial intelligence or clean energy or robotics, and you think, I need to add an AI-specific ETF to my portfolio to capture that growth.
It is a classic illusion of diversification that actually achieves the exact opposite.
Because VTI already owns all of those companies.
Precisely. If there is a publicly traded U.S. company pioneering AI or revolutionizing clean energy, it is already heavily weighted inside your total stock market fund.
You already own it.
By purchasing a specialized thematic ETF, you are not diversifying. You are creating aggressive redundancies. You are paying a significantly higher expense ratio simply to overweight your portfolio in a trendy, highly publicized, and likely overvalued sector. You are injecting active management risk back into a passive strategy.
You're paying extra to ruin the balance of the machine you just built.
Pretty much.
But the only active management this strategy actually calls for is an annual rebalancing. I want to break down the mechanics of that because it forces a highly disciplined contrarian behavior.
Rebalancing is a mechanical rule designed to strip emotion out of asset management. Let's just say you established your 60-30-10 split. Over the course of 12 months, the U.S. stock market goes on a massive tear, international markets remain flat, and bond yields compress.
Okay.
Because of that uneven asymmetric growth, your portfolio drifts. Your U.S. equity bucket swells, and suddenly you look at your account and you are holding 75% in U.S. stocks and only 5% in bonds.
So your portfolio has organically become drastically more aggressive and risk exposed than you originally engineered.
Exactly. So once a year, perhaps the first week of January, you log in to fix the drift, you calculate the overage, and you sell off a portion of the outperforming asset. You trim the U.S. stocks. And you use that capital to buy the underperforming assets, the bonds and international stocks, until you are perfectly restored to your 60-30-10 architecture.
And the genius of that mechanical rule is that it mathematically forces you to execute the holy grail of investing. You buy low and sell high.
Yes.
You are mechanically forced to shave profits off the expensive assets and redeploy that capital into the discounted assets, all without ever trying to predict macroeconomic trends or time the market.
It is entirely systemic. And, if you are in a taxable brokerage account and want to avoid the capital gains taxes triggered by selling, you can achieve the exact same rebalancing effect simply by directing all of your new monthly deposits exclusively into the lagging funds until the proper ratios are restored.
Oh, that's a great tip.
It requires a maximum of 2 hours of administrative maintenance per calendar year.
2 hours a year. So true investing success here requires embracing profound boredom. I think that is the single most vital, resonant takeaway from this entire deep dive.
I agree.
The financial media wants you to believe that investing is a high-octane, adrenaline-fueled battleground. But the reality is that the best portfolio is the one you will actually stick with. A simple, deeply boring 3-ETF blueprint that you automate and never touch will mathematically decimate a complex, hyper-optimized strategy that you constantly tinker with, stress over, and second-guess.
It is an incredibly empowering realization. You are reclaiming your cognitive bandwidth. You are reclaiming your time, and you are securing your financial future specifically by doing less.
Doing less to make more.
But, analyzing this required profound boredom against the backdrop of modern financial technology raises a critical tension that isn't explicitly addressed in the manuals, but is absolutely vital for a modern investor to navigate.
Wait, what's the tension?
Well, we established that the underlying funds and expense ratios at Vanguard, Fidelity, and Schwab are virtually identical.
Yeah.
It is a commoditized product. Therefore, the primary competitive frontier for these brokerages to capture your capital is the user experience and design of their mobile applications. They are competing on engagement.
They need you to log in. They need active daily users to boost their metrics.
Exactly. But the entire mathematical foundation of the 3 fund strategy mandates that you log out and remain profoundly bored for 30 years.
Wow.
So we face a structural contradiction. Are our modern brokerage apps designed to facilitate passive, boring wealth accumulation? Or are there UI frameworks, the push notifications about a stock surging 5%, the gamified color schemes flashing green and red, the frictionless one-click trading interfaces?
Yeah.
Are they specifically engineered to trigger the exact dopamine-driven emotional tinkering that destroys long-term compounding?
That is a staggering contradiction to consider. We are basically trying to execute a strategy of monastic discipline inside an environment designed like a casino.
That's exactly what it is.
It means the real challenge isn't understanding the math of the ETFs. The real challenge is resisting the behavioral engineering of the platform you use to buy them. You have to walk into the casino, put your money in the vault, and walk out without even glancing at the slot machines.
The strategy is wonderfully simple. Executing it in the modern attention economy requires ironclad psychological defense.
It requires knowing exactly what you own and why you own it. So what does this all mean? It means your money can work for you without you having to work for it. You have profound, liberating permission to ignore the financial news cycle, to dismiss the hot stock tips at dinner parties, and to embrace the boring, beautiful compounding math of the three-fund portfolio. Thank you for joining us on this deep dive. Check out the sources in our notes to review the data, the historical metrics, and the ticker symbols we discussed today. We highly encourage you to start your own deeply boring, highly profitable investment journey. Until next time.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.